Welcome everyone. I'll give everyone a chance to arrive here. It is, I called this meeting a little bit late, had some time, and I want to have a chance to speak with everyone with approximately 58 minutes remaining on the clock today. Here on day three, what I like to refer to as decision day of each week. And this is, of course, for week T 2025 minus 16 for September the 11th, 2024, quite obviously. Now, first of all, as we get this going, and something that I have echoed to, pardon me, as I keep one eye on the markets here and try to give you something up to date. Trying to echo to everyone in my hunting party and everyone online, heck, so as long as you've known me, certainly since the dawn of really early stages of social media. Today, it obviously is September 11th, 9/11. So your first thoughts, if you are a successful individual, should not have been of your valuations on your portfolio, your positions, or this and that, or whatever, but on the heroes, the lives that were lost 23 years ago, and of course their families, the changes, obviously our world, but most importantly to those lives lost and the families. That is priority one, and priority one always should be. You know, we have to keep our priorities straight. As I like to tell everyone before, or at least at the conclusion of each week, and sometimes I forget, and sometimes it's just a little bit short with my time after a long week, is the fact that for all the victories in your career, and you're going to have many, and the accolades you will receive, none will match the sound of your laughter of your children, the song of their voice, the joy in their hearts, or the hand of the love of your life and yours. So never miss a day to tell those most important in your life. They are such. 23 years ago, many a person went to work, got on a plane, or did whatever, and they didn't have a chance to really say that enough. So something to think about. Priority one. Priority one. And priority one, when we speak of the market, that's an interesting thing. The why we do what we do. I've been having I have great conversations. I should say I have been having. We have great conversations within our hunting party, in our private group and Telegram. It really is tremendous. They add so much value to my life, and I'm humbled to be, I hope, a positive influence to each one of them. It's a blessing in my life. I've often said that the people that I mentor, I never could thank them enough for that blessing to mentor. Being a mentor is a blessing. It's something you have to understand here. And I think they raise up my game. They raise up. There we go. Thank you very much. Great to see you. Thank you. But priority one in our investing, and I suppose we'll have to put a few clauses that, because I'm going to sit around and I tried to shave a little bit early just before I got on screen. Nothing like use a dry razor with a straight razor. Pardon me if I bleed out a little bit here. It's going to turn into a middleweight boxing match at any time. But quite honestly, the why we do what we do, that's the most important thing that one has to really give thought to. The why we do what we do. So why do I invest the way I do? A little bit about me. I wasn't raised with a silver spoon. I was raised in a pretty miserable situation. I wasn't so fortunate to go to, the best of schools. And I would like to have said that I came from those wonderful, prestigious Ivy League backgrounds. But no, I was so far from that wrong side of the tracks. I had to work to get onto that wrong side of the tracks. So it really made me appreciate things a lot more. The why we do what we do. When I was a young kid hired for that little old firm, two names, it starts with an M, goes with an L there afterwards, I couldn't believe they hired me. That was actually I started in May of 1983, and they gave a kid who probably would have earned his livelihood the rest of his life with his fists an opportunity. But I never lost track of where I came from and what the fight was to survive, to have a good solid meal on the desk, on the table each night, those kind of things. Great to see you here. Thank you very much. So the why we do what we do. Now, most of you listening here, and respectfully, this isn't meant to be condescending. If you're under the age of 55, I'm 63, you didn't have the luxury to walk in a wonderful having all these people walk into a large office, an investment office. The world changed radically. The death of full service brokerage. Yes, our commissions are cheaper, but unfortunately, many of you who may be watching this don't have an opportunity for a job in the investment industry, the financial industry. It's changed so much. The cost has been great. Yes, things are cheaper. They're so much cheaper that no one has a job in this sector, and I feel bad for younger people, a younger generation. You deserved better. But part of, if there was an investment era where you'd walk into a large office, those large buildings with huge office floors, those floor pans, where you'd see desk after these massive billions. I will try to read that question. Yes, thank you very much. You can barely hear me? Well, I'll try to speak up, but please let me know, because the volume seems to be, if anyone else has issues, please let me know. But why you do what you do. Thank you very much. Great to see you here, Kyle. Great to have you. Hope all is well with you and your loved ones. The why we do what we do is important. And if you had a chance to walk into, we would have discussed that. The why you do what you do should be multiple parts. But first of all, to provide for you and your loved ones. It's not to pay for short-term bills. Certainly that will be in a certain phase. You want to pay for your way, certainly to want to provide for you, but to pay for you and your loved ones, give you the quality of life that you want, whatever that may be. You decide that. Okay, that's up to you. I respect that. But to provide you the quality of life. And providing quality of life means a couple of things. First of all, wealth development. Audio is low? Okay. I'm doing the best here, but I will, I'll speak up a little bit for you if that helps. The audio, okay, audio is fine. There we go. Thank you very much, sir. I appreciate it. The why we do what we do is to provide for you and your loved ones. And I like to think for long after my days. I remember that when I was in my young. That's great. And for myself, one of the things that I think of is we fail to hear that much. Right now, if you're under the age of 55-ish, I could be off by 5 years or so, you haven't heard this enough. You haven't heard about fundamental investing. Remember, the people talking about fundamental investments, that's a 90s grunge video ready to happening. People haven't talked about fundamental investing in so long, real value. But the why we do what we do. So you want to provide for your loved ones right now. Give them a better quality of life. Raise the quality of life. Make sure if you have children that they have the best possible education. And I like to think also provide for your loved ones that family financial legacy long after your days. Part of that is wealth. Part of that process is wealth development. But not as much discussed. Not discussed as much, pardon me, of wealth development is maintaining wealth. Once you have it, you keep it. Once you have it, you keep it, you develop it. We're not here for bragging rights. We're not here for bragging rights. I guess some people have a little bit difficulties. I'm on an iPad. We'll see what that's like. I'll try my best. We'll see if this works out tomorrow with a different sound. So we'll see how this goes. Wealth development, wealth preservation. No one, you don't have to try to impress other people with your efforts. You only have to impress yourself, but you're going to keep your wealth. Now, the next stage of that development, that wealth development, wealth preservation, is investing in the future, or part of that process, I guess you might say, is investing for the future. And investing for the future should be investing for the future of your society, your community. And I like to think one of the reasons why I started this series and started this group 5 years ago was to invest in America, investing in the future. It has always been my belief that a strong, vibrant America isn't merely good for the American public or the American business community, but the world as a whole. The world needs a strong, vibrant America, strong, vibrant American economy. But something has fallen off the rails many a year ago. Again, we can look at this, whether or not you want to say in the near term, something fell off the rails clearly in the opening quarter of 2020. The money spent for a health matter was absolutely ridiculous. And as I said at the time, which got me barred and censored online, the money spent during that period is going to shackle generations forevermore. There will be no escaping that. Something for you to consider. But that wasn't the start. What is happening now is 40 plus years in the making. And it is really the wealth destruction of a people, as a country, as this republic, is at least 40 years in the making, and it is part of a grotesque mismanagement of fiscal and monetary policy. There is no escaping. This is a spiral. The spiral, I, believe it or not, started discussing in 1986. I was just a 25-year-old guy speaking in actual Newport Beach, of this, and saying that when my generation reaches nears that retirement period of 2025, that would be the first year of the retirement age of Gen X per House Strauss, which I identify as, and that as we reach retirement, there will be a debt bomb. Now, that was a guess, to be quite honest, and a very fortuitous guess, but sometimes having good luck is a little bit better than anything. And unfortunately, in this situation, I don't think it's really lucky to predict a debt bomb. This debt bomb is coming hard and heavy, and it's rolling down the hill, and there's no escaping. Now, I had a wonderful wonderful discussion with a gentleman who I believe is online today, and we were asked, the question was posed, what you should be doing in a plan, say for instance a 401k plan where you cannot hedge. Remember, 80 to 85% of my portfolio is sector leaders, or what I believe blue chip sector leaders or emerging sector leaders, that within the 5-year plan, they will be a sector leader. Other than that, if it's not a hedge or a proxy hedge, I'm not interested. Sector leaders or emerging sector leaders, and if not, then a hedge. Everything is hedged. If I can't hedge or it's a direct hedge, I'm not interested. Or, let me rephrase that. If it cannot be hedged, or is a directly hedged, or is a hedge itself or a proxy hedge, then why bother? Money made is money to be protected. You don't give money back to this market. You keep your money. You build wealth. You don't take away. Now, when we were asked that question, it pertains to a very notable question with individuals within a 401k plan. And we, my good friend and I, JJ, had this discussion approximately back in May. What do you do in the situation where you have, where you're in a 401k plan that clearly you can't be writing, say for instance, writing in the money calls. And as we were talking of, at that time we were talking of the end of the second quarter of the year. You get out, you sell, you close your positions. This market is extremely bloated. And I want to emphasize this, that it is prone to an extensive reversal. That might not come right away, but it's prone. And the vast majority of the public is going to give up the wealth that they have developed, some of it amassed through all of their lives. People my age that should be in retirement years, they will give that up as they watch the so-called, and this is, I think, a wonderful phrase for it, it's not mine, but the bubble of everything, or the everything bubble, finally bursts. Now, it is erroneous to suggest that corrections are coming at a specific time. This past week, on Thursday or Friday of last week, I saw a gentleman on social media suggest a crash is coming on Monday, and after Friday's close, that he said it's coming, this big crash. And that was in respect, given that Friday's strong sell-off. And I understand a young person is eager to look at charts. I started my career really as foremost with knowledge as technical analysis. To study charts alone is not the sole answer. It might provide you some very important clues, but is not the sole answer. And for that individual who suggested people be very short before the opening bell on Monday, it was very painful, and that was highly foreseeable. So what do you have to do here? First and foremost, if you can't hedge a position and it is not a hedge itself, it's time to get to cash. This market is prone to an extreme correction. From every sense of the word, this market is overstated, bloated. When we kicked off the 2020s, it was the S&P just approximately was 3,200. It was prone to, I would say, a 15% correction. It was a late stage economy, and it was overdue a recession, quite honestly. It was bloated beyond belief. There were some very awkward situations going on in the treasuries, and I was quite concerned in that capacity, but we were aware of that. Then, of course, came the nonsense in Q1, and you know that little situation with regards to a health matter, and that was approached horrifically in all levels, and you can't solve a health matter with throwing money at it, but what you did do was shackle a generation with debt. 5 years later, it's not going away. And by the way, throughout my entire lifetime, it's not going away. The debt, this is a slow building train, or has been a slow building train for, let's say, 40 years. And now it's coming down those tracks. It's out of control, it's spiraling. You can see this is classic chaos, and the turbulence. It's gonna spin off, and it's getting close. Whether or not that happens, that time where we become effectively a zombie nation where our tax revenue is materially less than our interest expense. I believe that will happen very potentially within this decade, but certainly I'm targeting, in a relative range within approximately 2033. But that can happen much sooner if some things fall into place that are unfortunately quite uncomfortable. So if you are in a position you can't hedge, I urge you, first of all, priority one of all assets, hedge. Manage risk before risks manage you. This is your money. Whether that means buying protective puts directly associated with that equity, so it's a very vanilla option position, or you write in the money calls, which is a very comfortable way, write 10, 20% in the money and get through these highly volatile periods, things that we can discuss in the future. But hedge, always hedge, tighten your hedge, make sure it's a tight collar, tighten that collar, manage risk before risks manages you. Now, as far as this market, the correction that it's prone to, this bloat up this week, this recovery where we are closing the gap to Friday, from last Friday's pullback, is extremely pullback. Yes, the market right now, we've got the Dow turning green, up 25.83, NASDAQ up more than 1.5%, 284.56, and the S&P kicking down the stall door, up nearly 40 points, 38.34, up 55.33. It's closed the gap from last Friday's sell-off. So if you decided to go short based upon very common, very juvenile technical analysis on Friday, you would have lost your shirt. You already might be out of the game. You might have destroyed your economic future. Managing risk. Managing risk does not mean increasing risk, does not mean changing your position such that you are now exposed to, in this situation, a market that has rebounded in a highly predictable manner. Why I can say that is because I easily predicted, and I didn't suggest that it was something very complicated to see. It was rather easy. The most dramatic part of this present market right now is the extraordinary fade on VIX. Hats off to anyone who decided to short VIX coming into this week. It's remarkable as VIX fades 1.15%. No, not 6%. Please, all the financial media sources read VIX wrong. VIX is a percentage. Don't look at a percentage on a percentage. It's off 1.14% to 1794. Gold, again, holding strong. Something big is coming with the BRICS conference in Kazan next month in October. It's certainly looking like that, and we're starting to see some resiliency in our silver miners. Do note that tremendous support right now at First Majestic really is astounding. However, let's get back to the point. The market is bloated. When will this pullback happen? Look, In 41 years, I've never seen anyone predict the precise movement of the market. And certainly online, absolutely everyone will spike the ball and suggest that they can. And I'm sure I can get many a person come on here and suggest they've got a handy dandy program, all available for equal payments of $19.95 they'll project. No, you're an investor. You're not a kid. This isn't a game. You're not looking to pay your bar tabs. You're looking to pay for the quality of life forevermore. Be an investor, not a flipper, but manage risk. Always wealth earned is wealth preserved. A part of wealth development is preserving wealth, pardon me. So where can this market correct to? I just want to remind you. First of all, let's just round this up to 5,500. I can't suggest to you that I'm absolute positive this market will regain some of that lost ground and continue that climb up to 5,800. I was suggesting back in February it's on the road to, it looks like it's on the road to 5,800. Did I say 5,500? My apologies. On the road to 5,800 with a lesser possibility in this ridiculous melt up to 6,000. All of it is stretched. You do not rush in front of the proverbial steamroller for pennies. You wait patiently for blood in the water, and there will be blood. But this might be a difficult one. Now, where can this market correct? I want to remind you a few basic things. First of all, call it 5,500 plus. Easy way to say it, 5,537 right now. 5,537, call it 5,500 plus. The mean, if we look at historical, if we go back in time and we look at historical future forward earnings, the mean of this is astonishing. This will turn your stomach if you think of this going back when I started my career in the 1980s. The mean would suggest the market could pull back to what, 1,650, 1,700. That's astonishing. That will blow apart the retirement plans of the vast majority of American households. It will destroy them. It will destroy those who have saved diligently and kept their debt down. Absolutely. The everything bubble will collapse. Now, if we're looking from, let's say, a recession, and I do believe we are either at or near a recession at this time, and it's very close. It's on the edge. But if so, we look at forward earnings on there. I believe the market, just in a very simple manner, valuation somewhere around 3,500. From 5,500 plus to 3,500, again, that's the point where, again, retirement plans are destroyed. Generations, plural, have lost their savings that they worked hard for 20, 40 plus years. It's gone, wiped out, because this market was bloated up. The irresponsibility of the Fed led this market to be bloated up. Remember, let's go back again, as I said, January 2020. We should have that pullback, call it 15% off 3,200, call it mid 2,800. That would have been relatively comfortable. From there, we'll have seen how the economy pulled around. But again, 5,500 from 2,800 from 5,500. This is a world of difference. But a recession pulls us in comfortably. Say a valuation of 35-esque. I still think that's overbloated and still very uncomfortable, but something to be aware. Now, a technical perspective, this market has defied technicals this opening nearly 3 parts of 3 days of this week, with approximately 34 minutes on the clock. It's defied. But however, if we're looking at this technically, I would say that it's prone to a correction in the vicinity of, call it 47.50 to 48.25, to a greater probability. A lesser probability, call it 41, section around 41.50. Am I comfortable with any of these? No, nor should you. You should not be comfortable at any time right now just investing in it. We're seeing some extreme blood in the water in the oil patch and some tremendous opportunities. My gosh, the opportunities, say for instance with Exxon, COP, Oxy, those are just, those are bellwether situations. And of course, my preferred is Exxon. I am an Exxon investor. I was very critical, and I hope it was appropriate of me. I hope I expressed it appropriately, of Mr. Jim Cramer when he critiqued Exxon in the March-April sell-off, calling his scriptwriters called it a perma-bear. I think that was inappropriate and it failed to understand the importance of Exxon. However, you get the point. The point is, and I'm not suggesting Exxon at this moment, all I'm suggesting is right now, the opportunities in this market very possibly lay within the oil patch, but hold off right now. It's very unsound. We have to get through to next Wednesday's announcement. And more importantly, Chair Powell's commentary. Remember, the announcement comes at 1400 hours. Chair Powell steps on the dais 30 minutes after, reads a prepared statement. That takes approximately 8 to 10 minutes, and then and goes through Q&A. And typically when he gets off the script, that's when sometimes the market tends to wander off. This market is far from stable, but I want to emphasize to everyone, you manage risk. If you are looking for bargains right now, I suggest you use some very strong tactics. First of all, be an investor, not a flipper. And points that here, if your time frame of your investing is less than 5 years, don't. The best investments are ones that you never sell, and unless you are a swing trader, and if you are a swing trader, study commodities and futures and learn to trade futures. That's where you want to spend more effort on. It's certainly more profitable, it's a better venture. However, give that but the best investments in equities are ones that last no less than 5 years, that are never sold, but the most investments you want to be thinking a minimally a 5-year period. But if you're entering anything now, and certainly between now and next Wednesday's announcement, when we start to get a little more clarity, and more importantly, between now and the November 5th election, use your tactical buy rights. Use your very conservative convergence spreads. Manage risk before risk manages you. So these are the points that I really wanted to emphasize, because most people are thinking that this market is akin to what you've seen in the last 5 years. Maybe what you've seen since really the recovery after 2008. That's not appropriate. Most people, investors, have simply been blind lucky in the last 5 years, if not the last 15 years. It has been very easy to make significant rates of return. Our options trading our selling strategies is lending to minimal 1.5% per week on a return on investment. And that is year after year after year. That's not, and yes, I take pride in my theories, but this is becoming easy layups. The average investor is getting very callous, very cavalier with their money, and this is when it comes down and they get hurt the most. We're approaching that period. I'm very aware that this market could blow it up further, but I don't want anyone to step in front of that proverbial steamroller for pennies. So one of the reasons that I'm calling today, besides the fact that I have to get used to doing these again, I need a few dress rehearsals. I hope you don't mind. It's been a long time since I spoke on camera to people, but I want you to reaffirm risk management. And as this market bloats up, remember, we're at a very unique crossroads. It looks like it's very much prone to a very steep, it is prone, and if it does occur, this is a very steep, and it will have great velocity on the pullback. Again, look for this, prepare for this, and conclude your week entering into how you look at good work, David, on that ball play. You look at how you manage risk going into the new week. One of the ways that we have to do this and consider this, and we'll talk about this, hopefully we'll have time to talk about this tomorrow. Friday is our travel day as we start to make our way cross country, meeting with investors, small town alike, and sea to shining sea, is by using those in the money calls or long puts going into from Friday close to Monday opening. You want to guard against those gap downs, those Monday gap downs, and you want to actually guard against gap downs any day of the week when this market is in such a level. So these are the points that I really wanted to emphasize. If you're in a position that you cannot hedge, get the cash. If you're in a position that you have 16 positions that are not hedged, hedge, tighten it, tighten that collar a little bit, turn the notch a little bit tighter, that your hedges, your downside, your risk your risk management is addressed tighter. You want to make sure that you eliminate and reduce that tail risk, frontier risk, as much as possible. I hope that makes sense. This is a very important period because many people fail to understand part of the large equation of wealth preservation or wealth accumulation is wealth preservation. And that all relates to why we do what we do. Think of why you do what you do. That's going to be an answer that's a personal one for each one of us. You might answer differently at different stages of your life, and I understand that. For myself, it is providing and giving the quality of life for my loved ones, for myself, for the present term and long after my days, and to invest in my communities, invest in America, and leave something for future generations. I hope that makes a lot of sense. I hope you take my sincere wishes for you to manage risk before risk manages you to heart. It's meant with the best of intention, and as I said before, I'm here not selling anything, just trying to help out my community, okay? So on that note, I want to thank everyone for joining me. We still have another 27 minutes remaining, and as always, I'm John Davies. Thank you very much for joining. I want to remind you, be the hunter, not the hunted. Thank you very much, everyone. Take care. Bye-bye.